Microsoft's market capitalization is worth trillions of dollars, and market capitalization is the value of the company in the stock market. If market capitalization is equivalent to GDP or gross domestic product of a country, Microsoft would be richer than Brazil or Russia. Even Canada, it would be richer than Canada, and that's how hefty this business is. It's absolutely hefty, but market capitalization is only one part of the story. We have to understand the financial health and the future plans of the company, and that's exactly what we will tackle here in this video right now. Hello everyone, this is Risey, and welcome to my channel, The Quest for Wealth. Our valuation of Microsoft is divided into three parts. The first part is to establish the background and the business model of the company. The second part is to identify and evaluate the financial health of the company. And the third part is to identify the intrinsic value of the company and truly understand if the current market price or stock price of this company per share is equivalent or parallel to its intrinsic value. Microsoft is one of those companies that does not require any introduction, but for the purpose of this video, let us have a look at the various parameters or background of the company. Windows, which we know is owned by Microsoft, holds the title of the world's most used operating system in the world. With 39.95% market share in March, Windows operating system is still the most used platform in North America. Now, when it comes to being the biggest company in the world, we all know Microsoft does not need any introduction here. Microsoft has been one of the biggest companies in the world. As a matter of fact, when it comes to market capitalization, Microsoft ranks as third biggest company in the world. When it comes to market share of leading computer companies, the operating systems market share from 2012 until 2020, Windows has always been at the top of the competition there at 68.54% back in June 2021. Certainly, Microsoft has got monopoly. One of the business strategy of Microsoft is to acquire competition. When Microsoft sees competition starting to get bigger and becoming more prominent in the industry, they start to acquire the competition. And this has been the record of the acquisitions of Microsoft since 1987. And this has been going on and on until 2004, 2006, 2007, 2008, until now, July 2028, their latest acquisition is Soplari. And I have read the 10K report of this. This was bought mainly with cash. They did not have, or Microsoft did not have to take in debt to pay and acquire this company. This was mostly paid in cash. And these are some of the stakes where Microsoft invested some of its money as well. The U.S. Securities and Exchange Commission, or SEC, is one of the most important websites that you can check to see the various financials of a company. So here, let us search Microsoft, and these are the filings, and let's see the view filings of the company. These are all the 10K, the 8K of the companies. You can definitely come here. This is absolutely available to anyone who wants to see the various filings of the company. So now we will go at 10K, which is the annual report of the company. And right now we are at Microsoft. So looking at the top line here, the revenue of the company back in 2019 and then 2020, and the fiscal year ended, this is I believe in June 2021, we will see that with this is the total revenue. They started at 125 billion in 2019, and that grew to 143 billion, and that is even grown into 168 billion in 2021. And here with the net income, so what we wanted to see is that the growth of the net income as well. If the top line is growing, we want the bottom line to grow as well. And that is 2019, it was at 39 billion. In 2020, it grew to 44 billion. And right now, it's almost 130% growth at 61 billion. This is a staggering growth. And with this staggering growth, you will see in the earnings per share of the company that they had it at 5.11 per share dollars, and then moved to 5.82, and then that's 8.12. That's almost 130%. Again, you will see that the growth of the revenue here, or the top line here, has mostly trickled down to the net income, and that is certainly reflected on the earnings per share as well. Right now, let's go to the cash flow statement of the company. The net income from 2019 until 2020. As you can see here, this has grown, and this is a consistent growth. Financing. When we talk about financing, these are mainly the debt or liabilities that the company takes on. So there had been some debt payments by the company. Stocks issued. So stocks issued, essentially, these are the stock issued in the stock market so that the company gets more earnings from the stocks issued. This stock issues dilutes the stocks in the market, and therefore the earnings per share is diluted as well. This is the cash flow of the company from its investing. And looking here, there had been some property and equipment bought at 20 billion. There had been some acquisition at 8 billion, purchases of investments, maturities of investments, and sale of investments. So with the sale of investment, that is the positive one, and the maturities of investments here. And it has always been positive since 2019, 2020, and 2021. This is the net cash used in investing. So this is a negative one. It's not necessarily bad that this figure is negative, because the most important factor here is that the cash and cash equivalents of the company by the end of the period is positive. We don't want this to be negative. We want the company to have the cash circling in the company. And here we can see that the cash of the company has been moving up as well in quite a good pace here. Now, one thing that I wanted to point out there is that the total assets against the total liabilities of the company back in 2020, it was at 301 billion for the total assets. And in 2020, the same time, the total liabilities was only at 183 billion. So that's about 1.5 ratio there, meaning the company has got about 1.5 to $1.7 worth of assets against $1 of liability, and this is a good ratio. In 2021, it's 334 billion, and the total liabilities is about 192 billion. Again, the company has got enough, more than enough assets to cover its total liabilities. Now, current assets and current liabilities is another factor that anyone should consider, because the company should have enough current assets to cover enough current liabilities. That means current means the next 1 year. So what we want to see here, at least 1-to-1 ratio or 1.5-to-1 ratio. In this case, back in 2020, the total current assets of the company is at almost 182 billion, and the total current liabilities of the company is at 72 billion. So this is more than a 2-to-1 ratio. So there's enough assets to cover the liabilities, and pretty much the same case in 2021. Looking here at the item 6 of the report here, this is the management's discussion and analysis of financial conditions and result of operations. There had been various growth in 2021 as compared to 2020. For example, the cloud revenue increased by 34%, the LinkedIn revenue increased by 27%, and surface revenue increased by 5%. Now, one thing that I wanted to put your attention to is that in March 2021, the acquisition of ZeniMax Media, a parent company of Bethesda Software or Softworks, was purchased at a total of $8.1 billion, consisting primarily of cash. And therefore, the company is just sitting on tons of cash that they do not have to take on debt for acquisition and mergers. And this has always been the strategy of the company when it buys or acquires a company, a budding competition in the industry. It acquires the company to further expand the operation of Microsoft. Here are the key financial ratios of the company. So looking at the debt to equity ratio of the company, what we want to see here is 2 and below. And Microsoft has certainly made it way a home run here, because it never really reached the value of 1 even. This therefore means that the company, that it uses more of its equity than debt when growing the company. The return on equity, as a matter of fact, is absolutely a home run. As much as the other companies that I have taken a look at, this is one of the best return on equities I have ever seen, from 2013 at 27%, and then it just went up. There were some choppiness there, but nevertheless it went up, and a little bit choppy in 2018. 2019 is at 38%, and then at 48% or 43%. As a matter of fact, if you see 15 to 20% of ROE or return on equity, it is a good one. But in this case, it's more than 27 15% in 2015, and that's the lowest recorded ROE in the last 7-8 years. In some industries, in the banking industry even, there are sometimes, even with TD, if I take on TD, the best recorded ROE of TD Bank is around 12 to 15%. And with Microsoft, it is its worst recorded ROE in the last 7 to 8 years. Now, I know that the industry of TD Bank and Microsoft are totally different, but that is just for the purpose of comparison. The book value per share is another important factor that we have to look at. The book value per share of Microsoft has been increasing. This is truly a remarkable, hefty, financially healthy company. From 2012, it recorded 8.19. It has been growing. There's a little bit of choppiness there from 2016 and 2017. Nevertheless, it is growing until the trailing 12 months of 18.89. It is trading at its highest valuations ever. At the highest recorded one was at 289, and right now it is at 288. And if you will look from 2020 last year until today, it has grown tremendously like a rocket ship. It just went to the moon in just a span of 1 year. And yes, the company's financials, as we have seen in the SEC recording, the company's financials did make some growth there. And even looking, we have seen this a while ago at the SEC filing, the top line and the bottom line. There were growth in the top line and the bottom line. Now, this is the 11-year growth rate of the company from 2011 until September 2020 or even June 2021. And another thing that we have to consider is the earnings per share. The earnings per share, if we base it here, yes, it has been growing. It's from 3.08, and that was choppy from 2012 until 2018. And it stabilizes somehow from June 2019 until this calendar or fiscal year 2021 to 8.15. So these are the capital that are invested, and the company should be earning from it at 33% until fiscal year ended, almost 32%. As a matter of fact, this is one of the best ROE and ROIC that I have seen so far. These are absolutely good numbers. That is equivalent to less than 1 year of its earnings. And again, that is a beautiful thing. It's more like a work of art than just a financial report. I made a calculation here on the dollar cost averaging of Microsoft. As a matter of fact, if one person or if an investor had done a dollar cost averaging, meaning the person or the investor had just bought Microsoft and would not just care about whether it's high or low and just month in and month out, you just put in money into your account to buy the shares of Microsoft. In 2010, the stock average price that you would have bought Microsoft for was at $25.65 a share. In 2011, that's $20.88 a share. If you did dollar cost averaging and just bought the stock without looking at the market and just taking for granted the noise and the comments and all the news around, the dollar cost averaging of Microsoft in the last 10-11 years would have been $84.69 a share, and right now it is trading at $288. In conclusion, with liabilities worth less than a year of the company's earnings, and less than a year really is almost nothing, with return on equity worth 43%, return on invested capital at 31.9% in the fiscal year ended June 2021, with $8.77 free cash flow per share, this company is certainly not just reporting finances. This company is a certain work of art, but it is indeed an expensive work of art. And the question is, would you want to buy it at its current market price? And this is the reason why I would believe and I would think that dollar cost averaging would make so much sense as a strategy with this company. With PE ratio at 36 and PB ratio at 15, this company is absolutely overvalued. It's way up there. But the long-term returns of this company justify a dollar cost averaging kind of strategy. Thank you very much indeed for watching this video. I hope that you gained value in this video and in my channel as a whole. And if you did gain value in this video, please like, share, and subscribe. And I will certainly see you, hopefully, in my next video. Thank you very much.